it comes across really good when you get up this close to the mic.
Yeah, perfect. Okay, ready? Here we go. Welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, and financial and investment planner Mike Zaidlin of Madrone Investment Advisory. Our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Vacations are free. Their only request is a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme is big guys, and you'll understand when I ask the question. Our website is bestofinvesting.com. We're also on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Today's special guest is Kim Kaselionis from Breakaway Funding, and she's going to talk to us about crowdfunding. And we've known Kim for a number of years because she was the CEO of a boutique bank. Is that okay? A boutique bank?
It's perfect,
Okay.
Especially if you're a woman. We love boutiques.
Yeah. There you go.
Right.
All right, Kim, welcome to The Best of Investing. All right.
Thank you.
Okay. Don't forget, I go by Edward. Okay, Mark.
Hey, so Kim, so Breakaway Funding. So this is one of those new, crowdfunding companies that have been, coming up, springing up out of San Francisco and the Bay Area. So, what does Breakaway Funding do, and how did you get into space?
Well, that's a really interesting question. And first of all, I'd just like to say that the company's name is Breakaway Funding, LLC. And crowdfunding is really an interesting word. It has a lot of different connotations. And what I like to really talk about what we're going to be addressing today is really about community funding and how we can engage the community for the benefit of local economics and local economy. So I was the CEO of a community bank for nearly 16 years, and one of the challenges that community banks face, and if you're a business owner and you've ever gone to the bank and tried to apply for a loan, you certainly know this story, is that community banks love their commercial clients for a lot of various reasons, but when it comes to actually lending money to their clients to help expansion and economic growth, banks kind of have a little reservation. One of the reservations they have is that borrowers typically utilize all the cash that they have to keep the businesses going, and so their balance sheets really aren't that strong when they go to actually borrow money. And so what equity crowdfunding does is it enables business owners to go out and raise that cash so they can bolster their balance sheet and go back to the bank, and the bank's way more happier.
Typically, you would ask for collateral. So, on this crowdfunding, what's the collateral?
Well, it depends upon which partner you are in the capital raising equation. Are you an investor who's going to support somebody that you know and you've developed a relationship with over decades, or are you the bank? Because banks have opportunities to get government guarantees on their loans. So whether it's the SBA, who will guarantee up to 75% of a loan up to $5 million, or if it's the state of California, who will guarantee a loan for a bank, 80% up to $2.5 million. It really depends upon which person what partner you are in this equation.
So Kim, I just, my outlook on banks is they just like to say no. And so, my company, we do private money funded real estate loans, and we're thriving in our marketplace now and have been since 2009, thanks to, the banks backing out of the lending environment for, everybody who isn't an A-paper borrower, and there was that void that we pretty much filled. And so the opportunity for companies like yours for Breakaway Funding, is it really based largely on the fact that it's just so hard to get money from a bank these days, or is it more than that?
That was a big question, so I'm just going to answer it the way I want to.
There you go.
So in 2 parts, historically it's been the community banks that have had the will to lend to the businesses in the local communities. And over the last 5 or 6 years, the number of community banks has dwindled by 50%. So In 2008, there were about 14,000 community banks. Now there's less than 6,500. So that group that had the will to lend just doesn't exist anymore. And then we have another saying, it's kind of death by regulation. And so, you know, it's my personal opinion that the community banks oftentimes are the whipping boy or girl for Congress when it comes to somebody has to pay for the economic ills of our nation, and usually the community banks end up with 10,000 pages of new regulation. So the environment is not that cohesive or not that supportive of commercial lending. So you'll have to come back to what your question is because I got lost on my.
No, that was a good answer. That was okay. So you're looking for two types of clients, right? You're looking for both. You're looking to market to potential borrowers who are seeking capital, but you're also marketing to investors seeking higher yield returns through this new crowdfunding platform. Is that correct?
That's correct. So at Breakaway, we do two things. First of all, we help companies that want to raise capital develop and execute a capital raise under the securities regulations. And secondly, we help community banks and commercial credit unions participate in this emerging capital market we call crowdfunding. Because if you take a look at the volume of activity in the non-traditional space, you've got the likes of Prosper.com and Lending Club and Kickstarter notwithstanding. Yeah, they're a rewards-based platform. Between those three platforms, over the last several years, they've facilitated over $8 billion worth of activity.
Wow.
And the community banks aren't participating. So,
yeah, you know, it's interesting, and I don't know that much about this arena, but like with Kickstarter, for some reason, you hear people, they raise money, but it's like, 5,000 here, 2,000 here, and are these, quote, investors, they're not really, quote, promised anything. I mean, sometimes it seems like they're just donating their money.
Well, that's an interesting observation. So there are, in fact, 4 different types of crowdfunding platforms. 2 are regulated and 2 are not. The 2 that are not regulated are donation-based and rewards-based, which you've just described,
okay.
Rewards-based. So in a rewards-based crowdfunding platform, a donor contributes money in exchange for a tchotchke.
Yeah.
Whatever that tchotchke happens to be. So it's not really a transaction, so to speak, although the IRS is trying to figure out how they can tax that tchotchke. Because they do it as a sale.
But they don't get a donation. It's not a 501c3, so they don't get a charitable contribution on their tax return.
That is correct, and which is why rewards-based crowdfunding platforms are great for consumer products that have mass market appeal. If you don't have mass market appeal, people have a hard time contributing to for-profit companies and not getting something in exchange. So it's not really a platform where for-profit companies should count on raising a lot of money. Yes, we hear the sensations of the salad, the potato salad, or the, this or that, the other thing that have really sparked a lot of consumer interest, but by and large, rewards-based crowdfunding is not a place for you to raise a lot of capital.
All right. You want to say your question for
Sure.
Coming back after the break? Okay, we're going to cut to our first commercial break. I told you, it goes quickly here. Before we do, if you remember last week, we had a special trivia contest where the winner was going to get a 2-night stay at the Martine Inn, a beautiful bed and breakfast overlooking the Monterey Bay in Pacific Grove. So if you need some relaxing time for yourself, check out the Martine Inn, where you can leave the hectic pace behind and watch the waves of Monterey Bay crash against the rocky coastline of Pacific Grove. And while having a different gourmet breakfast every day, you can walk to the Monterey Bay Aquarium and stroll along Cannery Row and take a look at that. Book a stay at martineinn.com and feel refreshed. Now, the question was, almost a quarter of us have never been here. Where? That's a tough one. And the answer was inside of our neighbor's house. And we had a winner, Angela from Fremont.
Oh my goodness.
Very good.
Congrats.
Okay, so now we're going to go to the commercial break. Here is our trivia theme again. It's big guys. Remember that? Mm-hmm. On the TV show Night Court, if you remember that from a long time ago, what was the nickname of the tall bailiff? All right, the first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 912-1190 to answer this question. On the TV show Night Court, which I think ran in the 80s, maybe the early 90s, what was the nickname of the tall bailiff? I decided this week we're going to ask harder questions because Mike Zalin always gets these ones correct. Not this time. Okay.
Not true.
All right, stay with us. You're listening to The Best of Investing. When we come back, Kim Kaselionis from Breakaway Funding, LLC is going to answer some more questions for us. Stay with us. Okay,
Cool.
good. I told you first, fast, second, right? Good job. So again, just remember, if you're going to talk to these guys, just pivot this way. That's all. All right.
Is there a specific
Is this loud or not? Or is it just booming in my ears?
Oh, it might just be booming in your
hold on.
area. Yeah, so. Is there a specific question you want to answer? Because I want to make sure we don't,
Yeah.
gloss
I should
over.
have chopped them up a little bit.
We've already
because
gone
it is
off, but
such a big topic.
It is a huge topic. 'Cause what I was going to ask for the break, what I'd like to ask is just how does Breakaway differ from, some of the many crowdfunding, companies that have popped up over the past couple of years.
Well, I have a question too, and that is, how does an investor determine how to evaluate this?
Yeah.
And what are the risks?
Excellent.
And just why would anyone do it? And just really.
Okay, so that was one of them he was getting, but
No,
go ahead.
no,
Yeah,
go
well,
ahead.
let's just,
That's a
there's
good-
enough stuff to
Yeah.
bounce around, so go ahead.
Because I know
That's a good
I pulled up
question.
my browser that I have on my phone, and I'm just looking at these: Patch of Land, Fundrise, Realty Shares, Funding Circle, SmartBiz, Better Finance, On Deck, RaiseWorks, Cabbage, Circle Up, Breakaway, Dealstruck, Biz2Credit, Lending Club, Prosper.
Yeah.
All these are supposedly
Are they-
peer-to-peer. I won't do that on the radio, but.
Are these Reg D? Is this
Oh,
for accredited
We
investors?
are Reg
or-
D. We are Reg
So
D.
an
I
investor
think
has to be accredited, or?
not necessarily, because there are a number, so we can go into that. Hope I don't lose your listeners.
Well, we try to get too technical, but, these are.
Right.
Yeah,
Yeah, but some shows are so vanilla, boring. It's like an idiot would know what they're talking about. So,
Yeah, every once in a while you get,
we have actually some pretty good listeners. A lot of my clients listen to the show. Oh, I heard you guys on the radio for a break on Saturday. Really? So we have at least 5 listeners.
Okay, ready? Here we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Mike Zalin. When we cut to the first commercial break, we asked this trivia question. Again, the theme is big guys. On the TV show Night Court, what was the nickname of the tall bailiff? Remember he was bald?
Drawing a blank. Was it
Drawing a
Lurch?
No. Bowl.
Oh, that's right.
Remember
Bowl.
Bowl? Okay.
Yeah.
And we are in the studio here with Kim Kaselionis from Breakaway Funding, LLC. And Mike, you want to ask a very interesting question.
Yeah, I wanted to ask him what persuades investors to invest in these types of investments, and can you tell us a little bit about the returns or what the risks are and different things like that?
It's an excellent question. So a couple of things, each investor has their own lens through which they make their investment decisions. Some investors are geared towards ROI with low risk. Others are more interested in supporting companies whose missions are aligned with their values, etc. So it's really up to each individual investor to make their own investment decisions. Having said that, however, the rates of return will vary depending on what kind of offering any platform has to offer. So whether it's a peer-to-peer lender, which will be notes that have principal and interest payments over some period of time, or an equity investment, which of course you have to typically have a more patient investor, and each of the exit strategies should be described in the private placement document or the business plan. And then you've got convertible debt, so you have an opportunity to get in early, get in at a good price, and then when the company does a second raise and the stock can be valued, then you convert your investment vehicle from a debt instrument to an equity instrument. So it really depends upon, there's 31 flavors out there,
Yeah.
quite frankly. There's
Well,
something for everybody.
Do companies come to you and then they say, we'd like to raise money? Is that how Breakaway Funding works?
Typically, companies come to us and say, we have an idea, or we have a plan, or we've tried to raise money before and we're not getting anywhere. And so that really is the starting point. Or do you have a fundable business plan that people are going to be able to believe? Have you identified your target markets for your customers, and have you really identified how you're going to get your investors out? That's one of the first questions I would ask is, how am I going to get out?
Well, I want to go to Hawaii. Can you raise money for me on that? I'm sorry, go ahead, Mark.
Well, would it be fair to say then that one of the ways that Breakaway Funding differs from some of these other platforms like Lending Club or Prosper is that you're not really making loans, but you're helping people raise capital to start a business or grow their business?
Yes and no. So Lending and Prosper are peer-to-peer lenders, and they do strictly loans. Breakaway Funding is agnostic in terms of what type of capital a company may want to raise, because there are different vehicles that are better suited for certain business plans than for others. And one of the things that we really like is this hybrid, which is take a piece, raise some money via equity and marry it with traditional bank financing. So you maybe get the best of both worlds. It helps the equity investors maintain more ownership. And so it doesn't, the debt piece doesn't dilute the owners.
Well, you ran a bank for so many years, so how do you put that together? I mean, like, do you bring that to the bank that you were the CEO of, or?
I wish if it were still around.
Well, it got bought out again.
Yeah, so how you put it together is a lot of education with the community banks and helping to educate them and introduce them to this opportunity. Look, if you take a look, let's talk about what is the definition of crowdfunding. Crowdfunding is defined as when a large group of people combine their economic power, right, their cash, to support an organization, company, or project they believe in, usually over the internet. And we talk about crowdfunding as being new, and it's really not. That is a way that our businesses have been funded for thousands and thousands of years. Back in the old days, blacksmith wanted to open up a shop. They went to the town elders. They pitched their idea. The elders liked it. They pitched in their money, and then they showed up to make sure that the business was running and operating, and that the owner didn't abscond with the cash. The same is true today, and for the banks. If you take a look at the way that community banks are actually capitalized in the beginning, like Circle Bank was, a group of community members got together and they say, hey, we need a community bank who wants to be on the board. Great, so 12 people get around the table. They say we need to raise some capital, open up your Rolodex, let's go raise some money. That's crowdfunding.
Yeah, but those people got something for that. They got shares in the bank.
Indeed.
Okay.
Indeed, and the same is true with securities-based crowdfunding, not the donation or rewards-based, but the debt and equity-based. The investors will either get a piece of the business or they will have a debt instrument like a loan.
So Kim, we talk a lot about real estate in this show, and can real estate investors seek funding through the crowdfunding platform?
You bet. In fact, because of the dollars involved in real estate crowdfunding is the largest growing segment in the crowdfunding space.
So give an example. So let's say, what are you thinking of, Mark? Like an apartment building?
Well,
Or?
is it appropriate for, say, real estate investors who are buying, fixing, and flipping, or buying and holding, or what would be a typical example that you would be able to help with?
Certainly. Let's say I'm going to revert back to the banks because that's really where my focus comes from. Let's say I had a client who was leasing their commercial building, and all of a sudden now they have an opportunity to buy it. But the bank requires 10% down before they'll do a loan. But the business owner only has 5%. That business owner can go and equity crowdfund for the additional 5% and then go back to the bank and say, hey, I have my 10% down, how about that loan?
Well,
So
it's almost like
your down payment.
Well, it's almost
great.
like in the old days of buying a house, and you get money from mom and dad, but the bank really didn't like to see gifts or whatever as part of that. They wanted to see it coming from you directly, but banks are kind of listening up. It's changing.
I think that's changing in terms of cash is cash is cash. So however the business owner can aggregate the required liquidity or the cash is great. And I wanted to say another thing about crowdfunding or this community funding and the engagement and the benefits that it has or it brings to the table for business owners. Two things. First of all, there are two primary reasons why a business might crowdfund. One is financial, seems self-explanatory.
Sure.
The other is strategic, however. I'd love to give you a great example. Up north in Petaluma, there's a hotel called the Hotel Petaluma Hotel. That hotel was crowdfunded in 1922. 850 community members gathered together to raise $350,000 to construct the hotel. The existing owner was considering selling a piece of that back to the community. Why would he do that? Well, for one thing, the hotel was built in 1922 and it probably needed some upgrades. But the second one is equally interesting, and that is the strategic component of crowdfunding, and that is if he were successful in selling $2 million, say, of the hotel back to the community, where are all those owners going to go for a drink, to bring their friends for dinner, and to bring, where's Aunt Marge going to stay?
Jackson's Hardware, didn't they sell via an ESOP to, which is basically the employees, it's an employee-owned business, and I think, isn't that how the owner basically got out, was he sold the business to the employees?
Exactly.
Along the same lines.
Exactly. So it is a really flexible financing tool.
So from an investment standpoint, could I use money from my IRA or retirement plans to invest in a crowdfunding platform?
That is a great question, and the short answer is yes, and the long answer is here it comes. So if you look back at one of the preambles of the Jobs Act, where were we in 2011, early 2012? We had high unemployment, no capital markets, the banking industry is collapsing, and we're in the beginning of a political, or in the middle of a political presidential election. Somebody looked around and said, where's all the money? We're not going to get reelected if we have bad economic news. So we need to get capital to our jobs creators so that we can fix the employment numbers. Well, they looked around and said, yeah, there's about $17 trillion sitting in cash in American retirement accounts. We got to get access to that. And then somebody else said, well, who owns that money? Well, that money really belongs to the average American. How are we going to do that? Hence the Jobs Act. So the answer is yes, notwithstanding the Title III of the Jobs Act is not available yet nationally or in California. You can use a self-directed IRA to own private equity investments.
Very good.
So you guys are open for business. You're currently making loans. What are some of the companies that, I'm assuming they're local companies, that have taken advantage of your funding platform?
You and your loans. I'd like to just to correct you on that. So
sorry, I'm
my
a
dear.
lender. That's the only word in my vocabulary is loan.
Yeah, your default browser.
Raising capital. I'm sorry.
Raising capital. Right. We're a service provider. The companies that we're working with right now are predominantly in the San Francisco Bay Area, and we have a great example of what we believe will be the first hybrid transaction, and that is the Cadillac Bar and Grill. It's a great story. Can I tell you?
Yes.
Yeah, we have just enough time to tell that.
Tell my story.
Yeah, and then we'll let you tell everyone how to get a hold of you.
So Michael Rodriguez owned the Cadillac Bar and Grill in the 80s and 90s south of Market. And when the Moscone Center expanded, he was displaced. It was a great place to be, very profitable, very successful company. Michael, the restaurateur, is bringing the Cadillac back. And so he has a lease in the Twitter building on 9th, and he has funding requirements of X million dollars. And the way that the project and its operating capital is being funded is in part by landlord tenant improvement concessions, part Michael, part his community, and part bank financing. So it is going to be a wonderful example of how hybrid funding can work to support innovation and job creation.
Well, great. Thank you very much, Kim Kaselionis. You did a great job for Breakaway Funding, LLC. If anybody in the audience wanted to get a hold of you for either having an idea or how to invest, how do they get a hold of you?
Certainly. Please visit our website at breakawayfunding.com, or you can call me at area code 415-729-9482. Once again, that's 415-729-9482.
Great, thank you very much. Okay, we're going to cut to our second commercial break. Trivia question here, talking about big guys. In the original Addams Family, who played Lurch? All right, the first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. In the original Addams Family, who played Lurch? Who played Lurch? All right, stay with us. The Best of Investing will be right back. That's weird. That thing looks really weird when I did that. Okay. Kim, you did great.
You've been on the radio before?
Nah.
You did great.
Awesome.
The answers need to be shorter. Sorry.
That's okay.
I don't know if
That's okay. That's why sometimes we'll kind of break, interrupt for a minute. And stay with
We're
us, because if you want to,
Well, we're done with that.
we're done with this
First
part,
hour,
but if you
yes.
wanted to, hang around and listen, and you can ask questions to these guys too.
Yeah, it's fun. It's
kinda-
kind of
it's fun.
interactive.
Yeah.
Again, it goes fast.
And so the question that I was going to ask, which was, how do you make money?
And we can
I
ask
want
that
to
when
ask
you
you
get
about,
back. I mean, if
okay,
you want,
so I want
I'd
to
say
go
ask
back to
one
you about the
question.
risks though, even though we didn't get on the air.
Okay.
So, this is private capital. It's risky.
Of course,
yeah.
Right, and
Of
there's
course.
usually very little, so the investors are completely at risk.
Of course.
The banks can mitigate their risk through the guarantees.
Okay, and it's just the guarantee. They're not going to get the guarantees of all these little guys. It's going to be the guarantee of the. Promoter,
Yeah,
right?
so in Michael's case, there's $1 million bank loan. The bank
Yeah.
they will go get a 75% guarantee.
Collateralized.
Never, from this government, from the federal government. So if the loan goes south, no, not in the Jobs Act, under regular banking rules.
Okay.
So here's the cool
Let's
thing
be
for
a
banks.
bank.
Wait,
Yeah, I know.
no, it gets better.
Yeah.
The 75% guarantee, because the guarantee is a federal commitment, there is a very robust secondary market for that guarantee.
Paper.
So the bank
Sure.
can then go and sell it
Yeah.
at a premium and have a boost to its earnings because it's going to sell it at a
They
gain.
get
Commercial
some
paper.
due diligence underwriting them. I mean, they can't just.
In order to get a guarantee, you have to have the business owner has to have skin in the game, which is what equity crowdfunding can help produce, as well as fundable business plan.
I mean,
That's
the funny thing is even though we can all kind of laugh about the oh my gosh, the guarantees, but in the scheme of things, you're stimulating the economy.
That's the
Oh,
point.
heck
That's
yeah.
the whole idea.
That's the whole point.
Yes, it's risky, but you know what? It's still stimulating. You're giving people jobs to do all this stuff,
And support innovation. And there may be people like you, if you have, you want to go out and raise money. We've known each other for 20 years.
Mhm.
You know what? I'll take $30,000 out of my self-directed IRA. I'm going to put $5,000 into, 10 different accounts or whatever it happens to be, so I can diversify the risk. And one or two of them I'm probably going to go to shit. But maybe I'll hit a home run on one of the other two. So it's a way.
And that's the appropriate attitude to do it with.
Yeah,
It's
you
not
definitely have
pension
to.
money. It's not.
Yeah,
Not that
it's not for the little old ladies or faint of heart.
So are we still?
I'll answer the trivia question. I'm gonna cut to you to say you had one quick last question for.
I think you just get it answered.
And I forgot. Am I?
You know what? It's funny. You're on here. It's just.
Well, I don't even hear him.
Okay, go ahead.
Okay. There we go.
Okay.
And I forgot what my last question was.
Oh,
What was your last question?
We don't have to. We can just move on.
Yeah, I actually did forget what my
Okay,
last question was.
that's okay. All right.
And it's probably okay.
So, Mike, you wanted to talk about the complexities of Social Security.
Or you can bring up that question about bonds and stocks.
Okay.
or
Okay. We'll get it right into email time, and then we'll. Okay.
whatever.
Okay. Right, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Mike Zadelin. Thank you very much, Kim, for joining us in the studio. Here's our second commercial trivia question. In the original Addams Family, who played Lurch?
A really tall guy with a deep voice.
And if you remember, he played a sultan on I Dream of Jeannie and a slave on the TV show Lost in Space, and he was also the voice of the Hulk for the TV show starring Lou Ferrigno and Bill Bixby.
It seems to me his first name was Ted.
Yes.
And it was like Ted Healy or.
Ted Cassidy.
Ted
Not bad. Not bad, Mike.
Well, he was one of my early role models. So.
Okay, we're going to get...
Low key, slightly pessimistic.
You kind of sound like him.
We received a couple of emails here. Mike, we received one for you here. It says, do you follow the typical advice of, quote, as a person gets older, they should transition from stocks to bonds?
Well, it's funny that you asked that because there's been a lot of research recently which says that it should almost be just the opposite.
Really?
Yeah, because the main problem that retirees face is sequence of return risk. In other words, if they retire and they happen to retire in a year like 2008 and they are 65 years old and have 35 or 40 or 50% of their money in equities and there's a 50% drop in the market, their retirement is really going to take a drastic hit. And so the latest thinking is that there should be a higher percentage of bonds early up when you have many more years ahead of you. So if you're 65 and you have a 30-year expected retirement, you would, under this theory, have a higher percentage of bonds up front, and then as you get older and there are less years to be financed, and you have therefore less risk if the equities do go down, that you switch to more equities later on. So that's a theory.
Even if interest rates are low, though.
Well, and that's another factor too.
Okay.
You have to like look up from the radar once in a while and see what's really happening in the real world. And if interest rates are 2% and you can't afford a retirement with interest rates at 2%, and you need to be more in the stock market, and that's exactly what's happening to a lot of people, is that the cost of a secure retirement has now gotten too expensive, and so they're forced up the risk curve to invest in stocks more so than they used to, because the 10-year treasury is at under 2%.
So even though the stocks don't produce generally, except for dividend-paying stocks, an income, the idea is get some capital growth, and then you can.
Exactly. The whole idea of stock market returns, anyways, the dividends are yield portion, but the capital growth is comprises the rest of the total return formula. So it's really unfortunate to see so many retirees having to be forced into the market to take on greater risk than they should.
You sound like a contrarian, but not really, because like you said, this is the latest.
I'm agnostic.
Yeah.
I want my clients to have safe retirements, and so I look more at annuities than I used to, because I don't want them to have to take the risks that the stock market entails any more than they have to. Of course, that being said, it depends on what their other goals are. So if if they're fairly wealthy and they have long-term perspectives for estate planning, and they want to pass along assets to their heirs, then it makes more sense to be in stocks, because over the longer periods of time, stocks have tended to do better than bonds. Although over the 20th century, the rate of return on equities, the real rate of return on equities was about 6% above and beyond inflation, and the real rate of return on 30-year treasuries was 2%. So there was a 4% premium on equities, which is not expected to continue into the 21st century. It's believed that part of the reason that happened was because the markets became more expensive and PE ratios went up. So there's a lot of skepticism about whether that 4% premium risk will continue, and that investors are wise to reduce their expectations going forward, because the PE ratios now are higher than they historically have been. So I don't know if I answered your question.
Yeah, no, you did. I mean, either the companies are going to have to make more money so that their PE ratios are back in line, or
well, and that's fascinating, because we did share an article, lead article in Forbes magazine last summer that predicted that very outcome. That in fact, they were saying that investors in stocks should expect to lower their expectations over the next 10 years, and that the market was likely to underperform people's general expectations.
Which is kind of wild, because we talked about 2000 to 2010 was the lost decade on that. So, Mike, I'm assuming that if people wanted to get a hold of you to have you look over their portfolio, you wouldn't charge for a consultation?
Right. Of course, I might dress up like Lurch, but
that's
part of it, right? That's
come on. You're a lot better looking.
Now they can sure. That's fine.
Okay. How do they get a hold of you?
They can reach me at 415-785-4585.
And that's Mike Zalin from the Drone Advisory. Mark, we received an email for you. It says, how much of a percentage of my portfolio should go into a fund such as yours?
So at our company, Pacific Private Money, we originate mortgage-backed investments that pay a fairly high yield, much higher yields than you're typically going to see in other investment opportunities. We're referred to as an alternative investment opportunity, and the types of investments we typically do are two types. One, we have a mortgage pool fund, which is where you can essentially write a check to a fund, and we use those monies to fund real estate secured loans. The second way is to invest in individual notes. Sometimes it's called trust deed investing, and that's where your name is actually on the note. You're actually the lender. In both cases, we like to call it being the bank and making money like the banks do. And we generally make what we consider to be conservative loans. We generally never go more than 70% loan to value, and oftentimes we're quite a bit less. In fact, our mortgage pool fund right now, we just closed out 2014, and our weighted average loan to value of the loans in our entire portfolio is less than 50%. So
I don't
48%.
That's like unprecedented. I mean, seriously, I've seen a lot of funds and never below 50%. That just doesn't.
Yeah, we just got a lot of because we do both individual note investing and the mortgage pool fund, we just cherry pick the really, really good loans that come in, and we put those in the fund. And it's a non-leveraged, conservative fund. And
What's the yield?
well, we ended the year, for those who are taking monthly distributions, in 2014, we averaged 8.14%, and our growth investors who were getting a compounded yield got 8.45. So
That's
it's
amazing.
actually a very good year for our second year in operation. We expect those yields actually to potentially improve over time as the fund grows, because the expenses as a percentage of the fund tend to go down. But to answer the question, what percentage of my portfolio, generally the government would prefer that you do not, as an individual, invest more than 10% of your net worth into what's called alternative investments like trust deeds, mortgages, and mortgage pool funds. Now, we don't audit your financial statement, so you don't have to prove it to us that you don't. So really, it's your money, and you get to choose how you invest it. But generally speaking, 10% is the number we use.
So I have a question. We're often addressing the risks of stock market investments or other investments. And what are the risks of trustee investments in general?
Well, the largest risk is that if we were to have a portfolio that had a higher weighted average, and I would say that before the real estate market bust, mortgage pool funds at that time, many of them were investing in more speculative loans, and loans that were higher loan to value. Maybe their portfolio was in the 60 to 70% range, and maybe they had a number of loans that were individually even higher than that. And so when the real estate market crashed, essentially, and you've got a 30 to 50% reduction in values in your portfolio, now you've got a situation where the portfolio is upside down and the borrower's not making the payments. So that's really what happened to a lot of mortgage pool funds back then. How do we protect against that potential today? Well, having a 50% weighted average loan to value gives you a lot of protected equity in your portfolio, so that certainly helps. But generally speaking, we're not making speculative type loans. We don't generally make land loans or construction loans. We're lending on single family residences. That's the vast majority of our portfolio. And I think we're protected against a pullback in the market. There are a few folks out there predicting that we might see anywhere from a 10 to 15% pullback over the next 18 to 24 months. I don't personally subscribe to that belief, but we're prepared for it if it happens.
Yeah, and even if there is that kind of a drop, doesn't mean that people stop paying their mortgage on their house.
True,
right?
true. But if you have a 2008 sort of situation, then you've got a little bit more risk, I would think. Although again, the 50% loan to value provides a lot of protection.
It does.
Well, there is the adage is there's a correlation between risk and reward. So if you're going to earn 8% yield, you're going to expect that certainly it's going to be risky. And I get phone calls all the time, and sometimes the first question out of their mouth is it risky? And the answer is, well, yes, but compared to what? So you need to do your due diligence and don't put all your eggs in one basket.
Well, one of the risks of not investing is also the risk of seeing your returns eaten up by inflation too. So fortunately or unfortunately, everything does have to be compared with the alternative.
That's what I always say. It's based on alternatives. But here would be the follow-up question of this. Risk is, of all the loans you've done, how many have defaulted?
So we've done over 750 loans at Pacific Private Money since we were formed in 2008. And so we've had 2 foreclosures out of those over 750 loans. Now, we've had more notices of default filed, but all of those paid off in full. So, and of those 2 foreclosures, both those investors did not lose any money. Those were individual notes, by the way. We've never had a foreclosure on our fund, and we've got 100% performing loans in the fund right now.
I would like to just mention that from 2008 to now is a rising market in real estate.
Sure,
and
absolutely.
So it's a sample size that could be slightly skewed, but
I would agree. I'd be the first to agree.
Anything.
No, I'd be the first to agree. No, absolutely. This is not for everyone, and it's certainly not for a majority of your portfolio. This is a way and an opportunity for people to spice up the overall yield of their portfolio by considering alternative investments. And I would consider mortgage pool funds and individual trust deeds as I would with oil and gas type of related investments, or even gold for that matter. So
yeah, but you're not projecting to pay people 15% either.
no, we're not. We're
It's
not
staying in the 8%.
We're not in the hedge fund range.
No, exactly.
We do that. So for more information, visit our website, the website of our mortgage pool fund, where you can get information and sign up for information about the actual portfolio. We'll send you a copy of our current loan portfolio. Go to pacificmoneyfund.com. That's pacificmoneyfund.com. Or give us a call. We're in the Bay Area, 415-883-2150, and we'll send you all kinds of easy-to-read goodies about mortgage fund investing.
Very good. Okay, before we cut to the final commercial break, next week we're going to have another special trivia contest where the winner is going to get a 2-night stay at the Auberge on the Vineyard, which is located in Cloverdale, California, situated at the confluence of isn't that a neat word? I like that one. Of 3 of California's greatest wine-growing regions, Auberge on the Vineyard is the perfect starting point to discover the charms of Sonoma and Mendocino counties. Check them out at you ready for this? SonomaBedBreakfastinWineCountry.com.
I'm definitely going to misspell that.
Yeah, that's okay. If you just look up Auberge on the Vineyard, you will find them. You can
Sounds
also
French.
You can also call them at 707-894-5956. I took a look at the website, and it looks like a very relaxing bed and breakfast to enjoy the wine country. So check them out, Auberge on the Vineyard. So that next week, we're going to have a special trivia contest, special trivia question for that. So now we're going to cut to our third and final commercial break, and here is the regular trivia question for the 3-day, 2-night stay at the Lighthouse Resort. Okay. On the 1960s TV show, The Wild Wild West, I used to love that show. This guy played Voltaire, who was Miguelito's large assistant. And Miguelito was the dwarf, if you remember, okay? The bad guy. However, he went on to stardom because of his role as a bad guy in a few action movies. Who was this large man? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer this question. On the 1960s TV show, The Wild Wild West, he played Voltaire, who was Miguelito's large assistant. All right? Stay with us. The best of investing. We'll be right back.
Did those people, do those resorts comp that?
Which ones?
All of your giveaways?
Yeah, well, I'm involved with the Lighthouse Resort, but the Auberge, they give it for the advertising,
Exchange.
Yeah.
And you do this every week?
This has been every week for almost 4.5 years. Yeah.
We get a lot of random listenership because, you never know when you're going to be in your car driving around. So people will tune in. They'll be flipping stations. And then we actually do have a lot of regular listeners.
We've had people listening for the whole 4 years.
Yeah.
And one lady, she was so funny. She
I
answered a
remember
trivia question.
Investors on
And
this.
she actually, excuse me. She called the number, and I get the Saturday evening. I'll listen to the email or the voicemail. She says, "Hi, I'm just calling." She goes, "I'm not calling because I'm answering a trivia question. I just want to let you know I like listening to your voice. That's why I'm listening." Oh, okay, don't stalk me, but okay. All right.
So when does this air?
This Saturday at noon.
And do you listen to it first? No.
Well, what happens is I'm going to send these 4 segments to the station, to the Talk 910. They are going to put it together with the music and commercials, so that and then they'll send me a complete file.
I try to
Saturday.
listen. I usually listen online. I usually work on Saturday, so I'll have it on.
If you're in the car,
I'll
listen.
turn it on.
And if you miss it,
It
you can
sounds
just
great.
listen online a couple days later. Is that
Yeah, what I'll do is I
The Best of
upload this to the website, The Best of Investing.
But you can get the MP3 for it.
But it doesn't get there for a few more days after the show, right?
Well, I'll
It's as fast as he does it.
As fast as I do it, yeah. So I usually do it by Sunday night. I try to, and then the YouTube one will also be up on the website and on YouTube.
And he does
So
a Facebook blast to let people
Yeah, I try to
know.
do that too. So you can point people to, hey, in fact, whatever social medium you use, tell people, listen in because you were interviewed on the show.
So what did you want?
You'll separate. It worked. It was well.
So Mike, what do you have for segment 4?
I'm sorry?
What do you have for segment 4?
Oh, I was going to talk about Social Security a little bit, and
All right,
different claiming strategties.
I've got a little bit. I'm guessing it's
Why
going to
don't
be
you,
short segments.
Why don't you start off?
So
Okay.
I'll ask after the end. Something politically incorrect, 'cause I do that.
You want to say something politically incorrect?
No, I'm going to ask you something that's politically incorrect.
We try not to get too controversial.
No, it's just,
on the
it's
show.
nosy. It's nosy Nancy.
Okay, so we have 9 minutes.
Who are you going to ask? Edward?
I'll do.
Oh,
It's gonna
okay.
love it.
Yeah,
I just want to talk about how this whole thing works between the three of you. It's a shared cost. It sounds like these two are.
Basically, what happens is I pay the airtime and then I get reimbursed. That's how it works.
Yeah, and it's very reasonable.
Yeah.
All things considered, it's not what
I do it because I just love this, and then I help Mark on his fund. I'm like investor relations, so people call in, they'll call him, and sometimes he'll answer it, or he'll send it on to me, and I'll call people. All right, ready? Here we go.
Is there a trivia question?
Don't do that.
False start.
False start. That's our false
Just
start.
wanted to see what happened.
All right. The whole idea is I got to give the studio 5 seconds of silence before and after. That's why. That's it. I'm gonna ask the. Come back.
Oh, so how long is the second?
9 minutes.
Oh, so it's
not,
good.
hold on.
Okay.
Hold on. 9 minutes and 8. I got 9:16.
All right, you want to stay with me?
Okay. Ready? Here we go.
Try that.
Yeah. Okay. Ready? Ready? Welcome back to the Best of Investing. Last time for the show, I'm Edward Brown, your host, along with Mark Hunt and Mike Zaidlin. When we cut to the third commercial break, we asked this trivia question. Again, the theme is big guys. On the 1960s TV show The Wild Wild West, he played Voltaire, who was Miguelito's large assistant. I spooked you guys
Drawing
again.
blanks, yes.
You ready? Richard Keel. Remember? And then he ended up playing Jaws in James Bond.
That's right.
And the poor guy just died a few months ago.
Yeah.
At age 74. Okay. Who was on next?
It was me. I was
Yes.
going to. So, one of my favorite blogs to read is by Beacon Economics. They're a California-based economic prediction forecasters and founded by Christopher Thornburg. I don't know if you've ever had a chance to listen to him speak. Great guy, really smart, and fun to listen to. He makes the dry, boring subject of economics a little bit more exciting. And so he writes a newsletter, and I've got a copy of his end of year 14 newsletter, and we don't have time to go through all of the really cool things in here. Maybe we'll do some of that next week. But one thing that I must got to point out, and we talked about this, Edward, a couple months ago, about the fact that the headlines seem to be, well, California home sales disappointing, and every month you read, oh, they're down year over year, blah blah blah, and that's in theory, well, as far as the papers go, that's bad news. But he says that California home sales disappoint, but for a good reason. And so that's kind of the news behind the news. I love sharing that with the listeners. So get a listen to this. So home sales on the surface, of course, have been weak, but and that's been credited to or blamed on low inventories for lackluster home sales. But that's only part of the story. And they're saying that home sales have largely been disappointing, if you want to call it that, because of the drop in new foreclosure activity. So in other words, foreclosure activity, we're almost back to normal when it comes to notices, defaults, and foreclosures. So when you net the foreclosures out of the sales mix, what they're finding is traditional sales have actually been rising over the past year, such that this is really an underlying positive to the housing market. And it's masking positive strides made on the retail market side. So the headline home sales numbers might be lackluster, but the underlying trends are much better than the headline numbers would suggest. So I think that's good news, and of course they're actually fairly bullish on 2015 for the real estate market.
Can I go over to Mike? Okay, Mike, you hit the one thing you wanted to discuss today, and I know listeners would be interested in this, is the complexities of Social Security, especially for married couples and surviving spouses.
Yeah, what I've really noticed is there's a lot of ignorance about Social Security, and one thing about Social Security is it is an investment, and by that I mean if you make the right claim, if you have the right claiming strategy, your combined marital benefits can easily be $100,000, $150,000 more than if you have the wrong strategy, and actually probably a little bit more than that. And the strategies are so complex that I recently read a story about an MIT professor who looked at the Social Security regs and then told his Social Security expert, "Oh, I've come up with the right strategy." And he said, "Well, let me hear it." And he told him what it was, and he said, "No, that's not the right strategy." And there are, I think, 8,000 different combinations depending on. So, for example, let's say you have a married couple; they're both 66, and they could conceivably wait till they're 70 to file for their own worker benefits, and thereby increase their benefits each by 8% a year or so. What a lot of couples don't do, and should probably, is have the higher earning spouse file and suspend, which means that he or she has allowed the other spouse to collect spousal benefits, and you cannot get spousal benefits unless one of the couple files.
Here's just a basic question. If people go to Social Security and sit down with someone at Social Security, what are the odds that the person who's sitting behind the desk is going to know all 8,000 strategies?
Well, the odds are not good that the couple will get the exact best answer. The odds are good that they'll get decent information.
Okay.
But for example, the Social Security online calculators, I don't think take into account file and suspend strategies. And so immediately you're going to be not getting probably the best answer. But that's not to downgrade Social Security at all. It's complex, and they try to do their best. But
so what do you do? A couple comes in, and then
I run software that looks at many thousands of potential outcomes. Sure, because they're far too complex even for me to run on the top of in my head. And for anybody, actually, if you're going to give the couple the best answer. So, for example, if you have two people age 66, one should file and suspend, and the other should file for spousal benefits. That's almost a no-brainer. Yet most people don't do that because they're not aware of it.
Is there an app for this?
I don't know. I'm sure there's something, but you need the right software, and you also have to understand that if one is say 66 and one is 62, they could file, suspend, file a restricted application. One could take, depending on who the higher earning spouse was and the age difference, one could take the spousal benefit, and one could file for the worker benefit, and then it gets really even more complex with survivor benefits, because a survivor can file at age 60, whereas for your own worker benefit you need to be 62, and a survivor could choose between, should I take my own worker benefit at 60, and then depending on what the former spouse earned, collect on that benefit at age 70. So there are all sorts of combinations of ages and incomes and so forth. It's really something that needs to be done correctly.
I have a friend who he is of age 65 to start collecting, or 62, and he has a young daughter, 8 years old, and because of that, it's amazing how much she gets.
Exactly.
For Social Security.
Exactly. Right, because older people are having children. So if they're younger, and that may not have happened 40 years ago or so. So she would be entitled to benefits too.
It's almost worth having a lot of kids.
Although the benefits are capped for the whole family.
Oh, okay. There you go. So,
sorry.
Not having 6 kids wouldn't work on that. So again, why don't you give out your information if people have questions on Social Security?
But I can be reached at 415-785-4585.
Okay, Mark, we only have a quick minute to go. Is there any deals of the week? Anything special?
You know, we've got like 30 loan applications in our pipeline that have been green-lighted for funding. We're about as busy now as we've ever been. In fact, I'm so fuzzy. We've got so many deals. I can't really give you a deal of the week, but I'll be sure to bring one next week. The good news is that Dodd-Frank has been very, very good for private money and non-bank financing. Not necessarily great for the consumer.
Did you send a case of wine to them?
It was designed to protect the consumer, but really what it has largely been effectively done has reduced the ability to borrow at banks at 5% or 4%. And unfortunately, but fortunately or unfortunately, we are available as a plan B.
Okay, and so if people are interested right now, your fund is paying over 8%. You pay it on a monthly basis rather than quarterly, which works out to be about a little over 2/3 of a percent per month. Can you imagine that, earning in 1 month what most banks are paying?
We're averaging between 0.68 and 0.7, almost
Real quickly, give out your information, and then we'll cut to the.
Go to pacificmoneyfund.com, or if you're interested in how to borrow money from on non-bank financing, go to pacificprivatemoney.com. That's our brokerage website.
Very good. And again, we want to thank Kim Kaselionis for joining us from Breakaway Funding LLC. Here's our thoughts for the day. Sweat is your body crying for mercy. That's a good one. And obsessed is a word the unmotivated use to describe the dedicated. You gotta think of those are thought-provoking. Those really are thoughts of the day. All right, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. Und that's all that.